Moody's Investor Service has downgraded India's sovereign rating by one notch. That announcement came in on Monday evening. Moody's said that while this action has been taken in the backdrop of the COVID-19 pandemic, that is not the only cause of this downgrade. They go on to explain that India's long-term growth trajectory appears to have veered off track, certainly off the track that Moody's expected it to be on, that some of the inherent structural issues, such as the financial sector constraints, will continue to act on the Indian economy and pull it down, and also that as a result of this weaker growth, in the Indian government's debt to GDP ratio will be even higher than what it has already been. I'm going to go through some of those in detail, but let me tell you first what the rating has been downgraded to. We're at Baa3 negative. So while the Moody's has downgraded us one notch, they have retained a negative rating, which suggests that there is the possibility of a downgrade further within 12 to 18 months should conditions warrant it. Now, Moody's had upgraded us to be Baa2 stable in November of 2017. They changed the outlook negative in November 2019. And now following that, there has been a downgrade both to the sovereign rating and a negative outlook maintained. Now, a brief mention here that Moody's was always one notch higher than S&P and Fitch. So the downgrade for Moody's is perhaps pinches a little less than a downgrade from S&P and Fitch would, because that would take us down into sub-investment grade. With Moody's downgrade, we still remain in the investment grade category, but now consistently across the three rating agencies, we're at the lowest investment grade. Now let's get into some of the rationale that Moody's has put out. They say that the decision to downgrade India's rating came on the fact that India's policy-making institutions will be challenged in enacting and implementing policies which effectively mitigate the risk of a sustained period of relatively low growth, further deteriorating the government's fiscal position and stress in the financial sector. That then ties back into what they expect for growth. Now, remember, when Moody's had upgraded India, they expected us to move into a higher growth path because of reforms such as DST and the IBC, but that hasn't happened. In fact, they're expecting the Indian economy to contract by 4% this year. And even beyond that, they expect India's growth to remain below potential for some time now. And as a result of that below potential growth, you would see one, financial sector constraints continue to worsen. We already have an NPA, a bad loan problem, with bad loans at about 9% of the overall banking system's assets. There is a fear that could go back into double digits and perhaps higher. Also, the debt to GDP ratio, which is very closely watched by rating agencies, in fact, is one of the key triggers. Now, for India, in 2019-20, that number was at 72%. That's the general government debt to GDP ratio. At 72%, it was already 30 percentage points higher than what the overall similar rated category peers have, the median debt to GDP. Now, what Moody's is saying is that India's debt to GDP could actually rise even further to 84%. And while it will stabilize at those levels, it will be very tough to bring it down further towards acceptable levels. Acceptable levels would be somewhere close to 60% if you go by the NK Singh committee. And to get from an 84% debt to GDP to a 60-odd percent or even a 70% debt to GDP, you have to grow very high rates, at least in nominal terms. And Moody's does not see that happening. And as a result, they have gone and announced this downgrade. How will markets respond? Well, you saw some response in the currency markets and the non-deliverable forwards market, but the currency market participants tell us that this was not entirely unanticipated. The fact that there is a negative outlook perhaps may be slightly worrying for some, because it leaves open the question as to whether India gets pegged down below sub-investment grade as well. On the debt market, we've already seen outflows for foreign portfolio investors. Even though they have returned to some other Asian economies, they have not returned to India. So perhaps status quo will continue on that front. But what Moody's does for the broader environment is perhaps reinforce what we all already know through looking at individual data points, which is that the Indian economy, which had started to weaken a good 4-6 quarters before the coronavirus pandemic hit us, is in for a very rough ride, at least over FY21, and then perhaps continuing